IBM just had the worst day in its history. The stock fell about 25%, $69 billion gone in a single session. But here is the strange part. That money did not leave the stock market. It just walked across the street. If you own any big boring software company, treat this as a warning shot. Because what happened to IBM isn't really about IBM. It's about where every company is choosing to spend its technology budget right now, and who gets left behind when that choice changes. Here is what IBM told investors. Its early second quarter sales came in around $17.2 billion. Wall Street was expecting or even wanted it to be close to $18 billion. A miss like that is bad, but a miss alone doesn't usually erase a quarter of a company overnight. The CEO, Arvind Krishna, did not spin it. He said, "This quarter we faltered." When a CEO says that out loud, the market listens. So what actually broke? Not what most people assume. Stay with me, because the drop was not mainly about weak demand. It was about a swap. You might be thinking, a big sales miss means customers stop buying. That is the obvious read, but look closer. IBM's weak spot was its software and its older infrastructure business. Think the giant mainframe computers that big banks still run on. Customers didn't stop spending. They redirected the money. They rushed to buy servers and memory chips now, before prices go up even further. I'm sure you remember Apple recently increasing the price of its products across the globe due to such rising costs. One analyst put it bluntly, hardware is eating everyone's lunch. And here's the part that matters for your money. Watch what went up on the same day IBM collapsed. Cybersecurity company Palo Alto Networks rose. Memory and AI hardware names rose. The money that left IBM never left tech stocks. It just moved towards anything tied to artificial intelligence and the machines that power it. That's the real story. Companies have a fixed budget. Every dollar they pour into AI is a dollar they'll pull out of traditional software. IBM just became the first giant to show you that shift. Investor Chamath Palihapitiya called it the wheels starting to come off the old spending model. So what does my system say? It doesn't chase a falling knife. A 25% gap down tells me the story changed, not that the stock is suddenly cheap. The rule is simple. When a company lands on the wrong side of where money is flowing, a low price isn't a bargain, it's a warning. So am I buying IBM? No, I'm not buying a crash just because the number looks big. Since the stock fell so steeply, it may have a short-term bounce, but I would want real proof that the software business can grow again before I would believe this dump to be over. I'd rather watch and study the companies that are catching the money that left IBM. If this kind of no hype breakdown helps you, subscribe. I'll bring you these every week. And I'm curious, when a giant like IBM falls 25%, do you think it's a warning to run or the exact moment smart money goes shopping? Let me know in the comments.